Hi everyone. I think we're live. Yeah, we're live. Hi everyone. Today I wanted to go over what's happening in the banking sector, how we're exposed to it, the benefits and drawbacks, and of course, as Mitchell's asking here, should we be preparing for a recession? And since 2020, during COVID, when you stick $7 trillion into the system, it causes an awful lot of essentially what ends up happening is the market gets completely disjointed. You have huge amounts of growth, what looks to be fast contractions, inflation increases, demands brought forward, all of these different ripple effects make it really, really, really difficult in the very near term. So there's a lot of nuance when you're looking at the data today. Just like you go back, I think it was Q4 2021, and I think just about everybody in the world was calling for a housing market crash. And what we ended up seeing was house prices up 16% into June 2022. Very surprising, even though mortgage rates were already up around 7%. Really surprising. And so there's a lot of nuance. Essentially, the government took on a bunch of debt, gave it to households, and then households are in a better position with fixed rate debt. On the outset, you could say higher interest rates is going to cause a big problem, but there's more nuance to it. And what's happening in the banking sector is not a credit crisis. What happened during the global financial crisis was a credit crisis where nobody knew what the loans were worth. And the reason being is because a bank went out, they found somebody that needed a loan, they borrowed 500,000 and they were earning minimum wage. So they wouldn't even be able to make the first or second payment. Delinquencies after 60 and 90 days explode. We don't even know what that debt is worth because the person that ended up getting the loan can't repay it. And so that's a credit crisis where 50% write-downs on all loans, meaning that the book value of most banks is negative, meaning that you have a bunch of banking collapses. What we're seeing right now is a funding crisis. The quality of credit is fantastic. It's pristine. It's US government debt, which is a bankrupt institution in and of itself, the US government, but it's backed by the Federal Reserve. And you're already seeing that with an awful lot of the loans to banks at par in order to shore up deposits. And so what we're seeing right now is duration. So let's get into, like, most of this stuff is not difficult. How a bank operates is super simple to understand. Most people that say it's difficult probably haven't even opened the book to try and figure it out to begin with. But how banks actually operate is super simple. We're going to get into that in just a moment. Before we do, this chart here is going to explain everything that happened in the banking sector. There's going to be winners, there's going to be losers, and there's going to be a far more concentration in terms of the banking sector in the US. I think it'll take some time because of the Fed's facility to lend out at par. But I think over time, you're going to see a lot of consolidation, a lot of M&A, and you're going to see ultimately a much more concentrated banking sector in the US. So what we have here on the chart here is in blue, we have cash assets for small domestically chartered banks. In red, we have cash assets for large domestically chartered banks. It's important to look at regional banks and GSIB banks. GSIB banks are what are known as globally systemic important banks. And they have a lot more protection and backstop for deposits versus a smaller regional bank with assets less than 250 billion, which heavily relies on FDIC insurance, which we'll get into in a moment. So we're splitting up in, just think of it this way. In blue, we've got smaller regional banks. And in red, we've got larger GSIB banks. And what can you see here prior to COVID? You can see ultimately there's a certain level of the cash assets. Now, cash assets can be characterized as a number of things, but mostly what it is deposits. And what you can see is prior to COVID, deposits were at a specific level. And then 1 year after COVID, deposits tripled. They go up 300%. Why did they go up 300%? US government were literally sending people out checks to stay at home. So cash balances for households, businesses, just continue to swell and swell and swell. And all that cash is sitting on a bank's balance sheet. Here's what a lot of people don't realize. Everybody expects, let's say I'm with Citigroup and I want, or JP Morgan or whatever, and I want to transfer funds to my partner who also has a JP Morgan account. I expect there to be no fee, right? We have these expectations. Also, if I call up the bank, I expect the customer service agent to answer me promptly. And I expect to do that with no cost whatsoever. That cost is essentially taken on by the bank itself. As well as that, after the global financial crisis, as part of Basel III, all banks that are holding deposits have to pay a fee they have to pay an insurance premium for those deposits to the FDIC sort of bucket, essentially. And that insurance is going to backstop deposits. The slush fund is like maybe $80 billion today, something like that. And so just holding deposits on your balance sheet comes at a cost. It costs money to hold those. You need customer service agents. You need risk analysts in order to prevent fraud. You need all this sort of stuff, insurance. It costs money to hold deposits, believe it or not. And so what ends up happening is a bank has two choices. So one choice a bank could do is they bring in all these deposits. They could lend it out. They could give, Bob down the road a loan, right? So you can give a loan, which capital would flow into the real economy. It'd be creating more cash deposits, and that would be more cash flowing into the economy. So that's one thing that they could do. And they're borrowing on the short end. So deposits are the overnight rate. And they're lending out on the long end, which would be like a 30-year bond. So they make the spread a couple of percent there. That's one thing that they could do. They could also invest into long duration assets. This would be loans. That's one portfolio. Long duration assets could also be in a security portfolio. So this could be like 10-year government bonds, right? So you have like treasuries, and you also have like T-bills. And you also have ORP, which would be the overnight rate. So we'll just put overnight rate. So this would be the security portfolio, and that would generate a return based on what the market rate is. So if you put it into the overnight repurchase agreement, you'll get the Fed funds rate, 4.75 to 5%. If you put it into T-bills, it depends on the duration and the rate. So you could put it into a security portfolio, and then you have to hold it towards maturity, and you'll generate a yield, or you could lend it out. And if you've got enough creditworthy borrowers, this is a good option as well. And in both circumstances, the bank can make money here. It can pay its bills. And if there's anything left over, they'll pass it on as a savings on cash deposits, CDs. And that's essentially how a bank operates in its traditional form. But there's a cost on holding those deposits. And that cost is taken up by the bank. And so when we go back over here and we have a look at this chart here, look at that green line. What is that? That's the Fed funds rate. So heading into COVID, what did they do? They dropped the rate down to zero. And then what did the federal government do? They increased fiscal stimulus and increased the amount of cash deposits essentially on banks' balance sheets. So you're in a bit of a predicament if you're the bank. And the predicament is you get 0% if you put it into the overnight rate, but you've got 3 times the amount of deposits and the expenses are going through the roof. So what do? Well, what Silicon Valley Bank decided to do was they decided to put 90% of the cash deposits into 10-year treasuries. So they got 1.5%, right? So what does that mean? Well, what it means is the deposits that came in the door, if somebody wants that back, they need to have some cash on hand to give them their deposit. So if I get down to the bank and I want to withdraw $50,000, the bank has to be able to give me that liquid. So ultimately what ended up happening was right after the Fed put these banks in this predicament where they increased the cash deposits in tandem with fiscal stimulus, cut interest rates to zero, banks start adding duration to their balance sheet. Okay, it's not that much of a problem until you go from 0 to 5% on the overnight rate. And now all of a sudden, as interest rates increase, the value of those bonds decrease. Why? Let's say I put $1,000 into a bond at 2%, and now the Federal Reserve are offering 5%. Well, I'm not going to invest in that bond because I can get 5%. So the value of that bond would have to drop relative to the duration to a certain value that fairly reflects a 5% yield. And the unrealized losses on these security portfolios were massive. So much so that the tier 1 capital that Silicon Valley Bank should have had was negative if you factored in if you realized those losses. And so what happened with Silicon Valley Bank was people were concerned because they didn't have enough FDIC insured deposits. Only I think it was 15% of deposits were actually insured. That's not really a problem. It's not really a problem because the Federal Reserve are going to guarantee the US government's debt. And it was just a matter of waiting for 10 years. But the panic surrounded by FDIC insurance led to people pulling their money out of the bank pretty quickly. And the bank didn't have the money. They didn't have the money. Because if they had to take the 90% in treasuries that was now like 30% underwater, they're going to lose tons of money. The equity in the bank went negative and the bank collapsed. And that's essentially what happened. That's a funding crisis. There's nothing wrong with those US treasuries, even though the government is pretty much bankrupt, because the Federal Reserve will guarantee them. So here's what the solution was. So the solution was the Federal Reserve come out and they said, okay, you have a portfolio of $1,000 in securities. The average yield is 2%. Right now, the 10-year bond yield's at the time, I think it was somewhere around 4%. So this $1,000 is probably worth somewhere closer to $500, meaning your security portfolio is down 50% to fairly reflect the 4% yield. So although if you were to realize your security portfolio, you lose 50% of your money, the Federal Reserve said, don't worry about it. We'll give you a loan at par. So we'll give you a loan using this as collateral. So despite it only being worth half of it, we're going to give you the full amount of that loan. Now, people say this isn't quantitative easing. I would say that as well if I said higher for longer too. But anyway, it doesn't matter. It still ended up in the same scenario. What ends up happening is people are now concerned about FDCI insurance. $250,000 per account, not per person. So I can have 10 accounts with $250,000 each in it. I can have 2.5 million and it's fully insured if it's in 10 different accounts. But if I have 2.5 million in one account, I'm only insured for 250,000. So what starts to happen at all these banks? Well, what starts to happen is people start splitting up their deposits. They start pulling some money out of the bank, the excess above 250,000, and diversifying, putting it into other banks. And as they put it into other banks, what's ending up happening? Well, deposits, inflows and outflows are really volatile. The banks have no idea what the deposits are likely to be. It's really volatile at the moment. But what's happening is the depositors at these banks are trying to diversify the risk so that they're insured. Creates an awful lot of volatility. So in the case of, let's say, First Republic Bank, all of these people are saying, okay, we're only 50% insured. I have $500,000. I need to pull 250,000. They go to First Republic Bank. They've got too much duration. No problem. The bank will go to the Federal Reserve. The Federal Reserve will give them a loan, and then they'll give them the cash, right? They take that cash and put it into another bank. So what ends up happening? Another bank ends up with higher cash deposits. And now what does that mean? More expenses. What does that mean? It needs to flow somewhere. So let's pop back on over here and let's just zoom in even closer. Look what happens here to the red line and the blue line. Cash assets at small banks start to increase. Now, again, you can call it quantitative easing or not. It doesn't really matter. It really doesn't matter. Europeans tried to call NOC QE back in 2014 and 15 with the TLTRO program. Targeted long-term refinancing operations, they call it. A real fancy word for quantitative easing. And everybody ran with it. So right now we're saying it's not quantitative easing, whatever. It doesn't matter. Same impact. If you have a look at the Federal Reserve, I think we should be looking at assets anyway. I think it's this one here. If we have a look at the Federal Reserve's balance sheet, it increased pretty damn significantly, $400 billion. Their loans going into banks at par. And then those deposits are being diversified onto other banks' balance sheets. So you see deposits increasing at large domestically chartered banks, GSIB banks, and small domestically chartered banks. So deposits are actually increasing. Here's where it gets interesting. The bank now has a choice to do something, and this is really important. They have a choice. Going back to this example here, they can, or I think I wiped it anyway, but they have a choice. They can put it into a loan book and they can lend money out to Joe Blogg down the street who needs it to buy a new car or a new house or whatever. Or they can essentially buy treasuries, 2-year bond, but then they're buying duration and that could be a bit of a problem as well. Or they could put it into the overnight repurchase agreement. And every single night, they'll be on an annual basis, they'll be able to generate the Fed funds rate, 4.75 to 5%. So if we look at the ORP, the overnight repurchase agreement, what happens straight after this? Well, deposits at banks increase because the Fed are giving banks loans to allow for deposit outflows. That's sitting on a bank's balance sheet. The bank doesn't want to take on any duration because, one, they don't know when those deposits are going to be called, and two, there's a lot of uncertainty. So what do? They start funneling all that cash into the overnight repurchase agreement, and it continues to push higher. Went from $2.042 trillion up to $2.375 trillion. So about $300 billion flows into the overnight repurchase agreement, collects 4.75 to 5%. All these new deposits are not a risk. What ends up happening is certain banks are going to benefit and other banks are essentially walking zombies that are eventually going to collapse because the equity at those banks is ultimately going to be worthless. Why do I say that? Because they had so many deposit outflows. They took loans on the collateral, which is the interest expense, which is the treasuries that they already own, the long duration assets. They'll hold them to maturity. They'll pay it. They'll get the money back. They'll pay off the loan, and it's done. Right? The bank has no equity. So there's going to be a lot of zombie banks, and then there's going to be a lot of banks that really benefit from this. So if we have a look, there's, and the ironic thing is Silicon Valley Bank, their CEO actually petitioned for more lax credit conditions for smaller regional banks. And so what ended up happening was after the global financial crisis, so we have the GFC, right? And this was a credit crisis. This is a problem with credit quality. We didn't know what it was worth because the guy that ended up drawing down the loan in some cases, didn't even have a job. So the guy has no income to even pay for this loan, yet he was able to get a loan. So we don't even know what that loan's worth. Not the vast majority, but a lot of loans were worthless, right? And that's ultimately what happened to global financial crisis. This time it's different. This time it's different because you go back to this period and the Federal Reserve cut interest rates to zero at a point where deposits tripled. So in order to generate some income to pay for the expenses associated with those deposits, banks were forced, they weren't forced, we'll have a look at MTB Bank in a moment, the real value investors, but certain executives obviously are not very good value investors because they started putting the money to work in long duration assets without thinking, what about the high inflation that's starting to increase in 21 and 22? What if interest rates go up 25 basis points? Then I'm screwed. They didn't think like that. They just locked in 1.5% and got absolutely steamrolled. But that's government debt, and it's going to be backed by the Federal Reserve. You'll get your money back. It may not be worth the same after inflation, but you'll get your money back. So these are really good quality assets. There's no question about whether you're going to receive the par value of those bonds. They will receive the par value. There's nothing wrong with the credit. So it's not a credit crisis. What it is a funding crisis, because what happened was everyone's worried about FDCI insurance. They want their money back to put into another bank to diversify their risk. But the bank doesn't have the money. It's tied into 10-year paper. So they have to wait 10 years to get the money to give it to you. And then what ends up happening? Well, the first couple of people that come, you got to service it. You got to realize losses. What happens to the equity at the bank? Goes negative. The bank is insolvent. It's gone. Bank's down the toilet. Gone. And that was the risk that was happening. It was the funding crisis, but the credit quality is still very high. So here's in hindsight, we can figure this stuff out, right? In real time, in hindsight, all of this stuff is important and to be brutally honest, I didn't plan on buying MTB Bank. After looking through it, the question was, well, did any of these banks actually act responsibly and are they in a better situation? The answer was yes, but I didn't know that at the time. So it's in hindsight, we can figure this stuff out. So global financial crisis was a credit crisis. So it was a CC, a credit crisis. And since then, we have what's known as the OCC, right? So FDIC don't set the regulation. The OCC, it's the Office of the Currency Controller. No, it's the Office of the Controller of the Currency. Back to front. The Office of the Controller of the Currency. These guys set the banking regulation. And they set the banking regulation after the last crisis. So everyone's looking at the last inflationary crisis, which we've seen over the past year and a half. Everyone's looking at 70s, 80s, nowhere near like that. Well, everybody was looking at the global financial crisis when the banking crisis started to flare up. But the OCC set the regulation and the liquidity requirements to prevent a credit crisis. So this is not a credit crisis, it's a funding crisis. And the OCC done their job to prevent a funding crisis. But in doing so, what did they do? They created the funding crisis. So part of it's got to do with a failure of the regulator. Part of it has to do with useless bank management. And part of it has to do with the Federal Reserve royally screwing up and saying, we're not thinking about raising rates until 2024. And inflation is transitory and all this sort of malark. And then going ahead, and that was in 2021. And then in 2022, raising interest rates at the fastest pace in history, up 5%. So part of it's the Federal Reserve, part of it's the regulator, part of it's management. And if you got past all this, your management team is A+. MTB did. We'll get into that in a minute. So the reason why they created a funding crisis was they said to banks, hey, listen, you can hold high quality A+ rated credit, which would be government bonds. but they never factored in the duration risk. So banks need to hold a certain amount of, so I think I actually have this. So let me go back here. Lumentum actually is benefiting from all this as well, which we'll talk about a little bit later. M&T Bank, no, not this one. M&T Bank, I have it here, no? Maybe it's in there. Maybe it's in here. Yeah, it is. Okay. So here's the requirements, right? Common equity tier 1 capital. The minimum requirements for common equity tier 1 capital is 4.5%. Tier 1 capital 6%, and tier 1 capital to average consolidated assets 4%. There is also every second year, every even year, there's a stress test, and banks need to hold a capital buffer. And then after that, the capital requirements for tier 1 capital will be X amount. Every bank's different. This stress test, so this is the minimum plus your stress test capital buffer, and that would make up your capital requirement. And it's different for every single bank. So with the minimum, the OCC allowed for small banks that are not systemically important banks, SIBs, banks with less than $250 billion in assets, to hold this tier 1 high quality liquidity as long duration assets. So Silicon Valley Bank didn't do anything wrong. They just lacked foresight. They just looked at it and said, hey, listen, we're going to put all our money into 10-year paper without thinking interest rates are cyclical. And what if they increase? What happens to unrealized losses? Never thought about that. 85% of your bank is uninsured, your deposits. Never thought about it. So what ended up happening was the OCC, the Office of the Controller of the Currency, set the regulation to allow for banks with less than 250 billion to use long duration assets as part of the tier 1 liquidity ratios as set by Basel III. So this is more why the problem is with regional banks. One, systemically important banks are backed by the government. These are too big to fail banks. Anything over $250 billion, the deposits are safe. Anything below $250 billion, it's FDCI insured up to 250,000. And so a lot of these regional banks, they're screwed because their tier 1 capital, when you factor in the realized losses, if you realize some of those losses on their security portfolio, there's not a lot of liquidity left over. And that's where the big challenge was. And this is where it comes in. This is where M&T Bank really killed it. So Renee Jones took over in 2017. And I don't know whether Buffett and Berkshire Hathaway owned M&T Bank for decades. They sold out of it in 2021. That was at a rich valuation. I think it was about 2.1 times tangible book value, which is kind of rich for banks. It's very rich, even though they're a very profitable bank. So I don't know whether it was a valuation decision why they sold out of it or not. But Renee Jones took over in 2017, and I guess it was a combination of new management, challenging market environment, very, very lofty valuations. Doesn't really matter. Today, when we look at M&T Bank, these guys absolutely killed it. So they stress test the stress testers came out and said that the bank needed a buffer in 2022 last year. They needed a buffer of 4.7% on top of the 4.5%, meaning the capital requirements would be 9.2%. M&T Bank have 10.44%. Now, it's a regional bank. How much of that's liquid? This is where it's just absolute genius. We'll look at it in a second, but that's pretty much all liquid. There's absolutely no issue with duration risk. Tier 1 capital, 11.79%, and Tier 1 capital to average consolidated assets, 7.63%. The minimum deemed to be well capitalized, 5%, 7.63%. Fantastic. So this is ultimately where, like, I don't need to listen to management. I'll go over their commentary on one of their recent, last November, they had an investor day. We'll talk about how they speak about their business, because these guys are value investors. They're not really bankers, they're value investors. But we'll look at the decisions that they made. And this is really important. So just before we get into this, right? So you have NIM, net interest margin. And you have NII, which is net interest income. It's kind of like gross profit, but for banks. Because remember, as we mentioned a moment ago, there's interest expense on savings accounts, deposits, whatever's left over. And then you have interest income on what they lend out. So they lend out on the long-term rates. They borrow on short rates, right? So they borrow on cash deposits, overnight rate, etc. And the difference is what they make. So if we have a look at their investment securities, there's there's two portfolios. And here's the thing. It's not just the security portfolio that's a problem. The mortgage portfolio is a problem. Mortgage rates today are 6.2% and around there, 6.4%. Well, the average mortgage rate in the US is 3.3%. So it's only at the margin you're actually getting somewhere anywhere above 6%. And it's a very, 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 very small percentage of actual mortgages because sales are collapsing. Why? Because there's not a lot of inventory for sale because nobody wants to sell their house. Because if they sell their house, they're going to pay double in interest expense and house prices haven't come down enough. So nobody's selling their house. House prices are quite high. Even the loan portfolio is underwater, but we don't really count it the same. Security portfolio is usually more liquid for those deposit outflows. The reason being is if I extend you a loan, if I gave you 200,000 as a bank, where are you going to put it? You're going to put it in your checking account. So I increase your deposits anyway. And then you go and buy a house. And if it's in a specific region, a local region, it's highly probable that the person you're buying the house off banks at the same bank as you. So it goes straight back into the cash deposits of the same bank. It's different names. So let's have a look at this. Total investment securities back in 2018, 12.69 billion. And that was on total assets at the time of 120 billion. Securities as a percentage of assets were 10.57%. And if you look at net interest margin, it's 3.83%. Okay, that's really important to recognize. Net interest margin stays the same into 2019. 7.92% of assets are security portfolio. Into 2020, look what happens to the net interest margin. Drops down to 3.16%. What does that mean? Well, it means that the bank is unwilling to hold long duration assets because they're not getting a good enough yield. So they start holding less duration. Because if they get caught in at a low interest rate, you end up like Silicon Valley Bank. So as rates went down, these guys are not tying in long duration assets. They're doing the complete reverse of that. The reverse of what everybody else in the market was doing. They were getting rid of duration. They were going closer to short duration assets. Look in 2021, 4.6% dropped even further. Why? Because net interest margins were only 2.76%. And then in 2022, it increased to 12.56%. These guys are bloody fantastic, and I'll explain why in just a moment. 3.39%, it's a step up. But the vast majority of that 25 billion came in Q4, and Q4's net interest margin was 4.06%. So Q4's net interest margin was the highest it's been for years, and the bank now starts to add duration. They're tying in for the next couple of years a much higher net interest margin. They're earning more money, and they can do it because what they were doing with the cash coming in the door through deposits, they're putting in the overnight repurchase agreement. Why were they doing that? Let's pop on over here and let's listen to what they said. This was in November. Yeah, 3rd of November, 2022, M&T Bank Corporation presents at Bank Analysts Association of Boston Conference. Scroll down here. So he was asked the question, can you talk about how you resisted the pressure that impacted some of your peers to take risk? What's the question he's asking? He's asking, hey, listen, when interest rates were like 0%, why did you not buy 10-year bonds? Everyone else was buying 10-year bonds. Why did you guys not do it? And he said, so there's a big long-winded answer here, but this is really important. So we'd be on a call and we get lots of questions about deploying cash. All the analysts are coming on the call saying, hey, rates are 0. Why aren't you buying 10-year yields at 1.5%? Why aren't you putting it into 2-year paper? Why aren't you doing these things? And he said, we would say only 12 extra basis points is not worth the risk, right? So they would, if they left it in the overnight repurchase agreement, they get 8 basis points. Here it is here. At the time, the 2-year was only paying out 20 basis points. This is peanuts. This is absolute peanuts. I think it would work out that, and it was in a different call where the CEO said, and it was actually on the latest earnings call, Renee Jones said, look, if we put $10 billion to work, we would have made $3 million. $3 million a year. Didn't make any sense. The returns were just not there. So they stomached the costs on those deposits because the risk if rates started to increase would crush them. And they could stomach the risk because they had a pretty solid loan portfolio that was generating reasonable net interest margins. So rather than take the 8 basis point, rather than take the 20 basis points and fix your capital in for 2 years, they decided just to stick with 8 basis points that the Fed was offering. And it's 100% increase. And so it depends on which side of the trade you're on. So there was a lot of backlash to the management saying, but listen, you can double your net interest margin by adding duration. And these guys are like, yeah, but it's a pretty dumb investment. 10 billion to make 3 million. It doesn't make a lot of sense. And so that was ultimately the decision that they made. They looked at the risk versus reward and they said, we're not going to tie in any sort of duration. This is the management team that's running M&T Bank. It's complete 180 degrees from SVB, Silicon Valley Bank. Those guys, okay, again, the regulator has a part to play, and so does the Federal Reserve have a part to play. But putting 90% of your cash deposits into 10-year paper is just a special kind of dumb. It really is. Fair enough, they put 20%, they'd probably still be in a hole, but not anywhere near as big of a hole. 90% into 10-year paper is just special kind of stupid. And they paid themselves like millions of dollars. So, and I think there's an investigation to claw back all that payments, but that's just a really incompetent management team on top of a number of other things. These guys realize that, look, there's a bit of a challenge. We're going to get hit in the near term, but look, it's not going to hit us by a huge amount. And the net result is now the bank is in a situation where they're able to add more risk. So in Q4, let's have a look at US02Y. This is the 2-year bond yield. Let's go into the daily chart. This is the 2-year bond yield. Let me take it off log scale so you can see it a little bit better. This is Q4. This is where they started increasing duration from 4% to 12% and probably more. But that's where they started to increase duration. Look at where we are now. 1-2 quarters later, rates are lower. These guys nailed the move up, and now they're nailing the move down. They're in a really solid position, really solid position. And as they experience, and I would imagine they'll experience quite a bit of capital inflows for new deposits, as new deposits start flowing into the bank, they'll be able to put it to work, probably in an overnight repurchase agreement for now, collect 4.75 to 5%. Net interest margin continues to appreciate. They'll be perfectly fine while capturing a decent portion of their assets in a little bit longer duration, like the 2-year bond yield paying out 4.5, 4.6%. That's where they started adding risk. So here, they didn't want to take any risk here. This is what he's saying, 20 basis points. Here's where they're happy to take risk. That's a good bloody management team. So forget about what the share price is doing. This is a bank that has a really savvy management team. They're in a great position. Part of the reason why people are giving M&T Bank a little bit of a hard time recently is they made an acquisition. M&T Bank, M&T stands for Manufacturing and Traders Bank, and it was very much commercial. The vast majority of it was commercial. They acquired People's United Bank, which is retail. So they acquired a retail-facing division. Some people assume that they overpaid for it. To me, I don't really care about those things because I didn't overpay, or we didn't overpay. If we go over to valuations, normally the way you would look at a bank is, so let's just have a look at a bank's balance sheet here real quickly. If you have a look at a bank, you've got all of the assets that they own, mortgage-backed securities, trading securities, investment securities, loans, all that sort of stuff is assets. And then the liabilities are all the deposits, right? Because they're taking those deposits and then they're investing it. And so when you're looking at the balance sheet, the difference between the assets and the liabilities is the book value of shareholder equity. And this here is the net worth of the bank, right? So in this case, it's $25.3 billion, the net worth of the bank, the book value of shareholder equity. And when we're looking at banks, we tend to look at what's known as ROTCE, the return on tangible common equity. So tangible common equity in this case is a little bit less than book value. So book value is $137. Tangible, excluding out any sort of intangibles, the tangible book value is $86. And the return on that for the past couple of decades has been around 19%. So because it's been so high over the past number of years, the market has obviously assigned a much higher multiple to it versus something like Citigroup. Citigroup has a return on common equity of 10%. So it traded at more than 50% discount. But if you have a look at the valuation of this, it's getting close to the lowest point it's been, including the global financial crisis. The global financial crisis was the lowest point. It was 0.99 times tangible book value. And the reason being is they got good lending standards. If you pop on over here, it's not a case that these guys just woke up this morning and they're like, yeah, we know how to manage a bank. This here is from their investor deck, but net charge-offs as a percentage of loans. Look at what we're seeing. So this is like bad debt, essentially increasing or decreasing, depending on which period. But look at 2007, 2008. Green there is M&T Bank. Look at the peer median and the industry average. It's not a case that over the past 2-3 years, M&T Bank have just decided to wake up and like, we know how we're going to dominate this market. They've been doing it for a long time. These guys have been absolutely killing it for a very long time. And you can see that in the ROTCE, the return on tangible common equity. You can see that in the net charge-offs relative to its peer basket. They went through a credit crisis back in 2008, and they only had net charge-offs of roughly 1%, way below the 2.5% of the industry average. So when you're looking at these guys, they've absolutely nailed it. And when you're looking at the current period, which is a funding crisis, which is going to impact individual banks as opposed to the whole banking sector, we're nowhere near the situation that we're in the global financial crisis. Like anyone that's trying to claim that today's anywhere close to 2008, yeah, I would probably keep walking. I wouldn't have that conversation because there's no nuance there. When you're looking at the current valuation of 1.36 times book value, it's about as cheap as you're going to get. If you take 2008 out of it, that extreme low, we're at the COVID lows. And that's where there was a lot of risk. And you see that with Silicon Valley Bank. We're down around those lows today, yet they've absolutely nailed it. They've absolutely nailed it. I don't think there's any reason why they should be down here. So the risk at this point is like deposits are flowing out the door of regional banks, and it's flowing into GSIB banks because they're already backstopped. They're too big to fail, essentially. And so in doing so, everybody's assigning regional banks pretty much a zero. Not a zero. I mean, it's still trading at 1.36 times tangible book value. But it's still very cheap on a relative basis to historical standards, despite the good performance of the bank. Creates an opportunity, essentially. Sentiment's very negative. I don't know if it's going to start working today, tomorrow, when. But this is not a bank that we should see huge outflows because of the good performance. If new deposits come in the door, they can offer a high savings rate. Why? Because they'll just put it into the overnight repurchase agreement, take no risk, improve their net interest margin. As well as that, the crisis might already be over. It might already be over. And the reason why I say that is, let's zoom in here. Cash deposits increase into Wednesday, 15th of March. And then the latest data we have, 22nd of March, cash deposits started to drop. What does that mean? Well, it means that those deposits that came in the door have gone somewhere. Some of it might have been to pay off the Federal Reserve for those loans. Some of it might have went into new loans, into the real economy. And this is important. We don't know yet. We won't know until we start getting earnings reports, but we can speculate. So cash is flowing out of the overnight repurchase agreement. Cash assets at banks is going down. Are banks now making loans again? Possibly. So going back to Mitchell's comment here, should we be preparing for a recession? And what I mentioned at the very beginning, there's a lot of nuance in this market. The way I'm approaching it is I'm finding something that's mispriced, and I'll show you something that's very mispriced like Lumentum in a moment. The market doesn't catch on. Like, unfortunately, most people just peel the first layer of the onion and they don't have enough patience to see the fundamentals out. But we'll have a look at Lumentum in a moment where the fundamentals are very strong. We'll get into that in a moment. It doesn't really matter for right now. We'll just talk about a recession. We'll get into that in a minute because I don't want to go off topic here while I have it on my head. So recession, one thing I want to show you guys, right? So if we pop on over here to the calendar really quickly, if we go back to March 24th or 26th. So March 20, that's 20, maybe it's 20, it was 26th. So we have S&P Global Composite PMIs. We have services forecasted to come in. So what is the flash reading? It's PMIs, Purchasing Manager Index. It's the early reading for the service sector or the manufacturing sector. And I don't know what date this was taken as of, but it was reported on the 24th of March. It might have been the week before the banking crisis, right? But if you have a look at services, we know this morning services PMI, ISM PMI came out and it was really bad. Well, it wasn't really bad, but it was a lot worse than expected. Just 2 weeks ago, the flash readings were coming out, forecast 50.5, actual 53.8. The economy is really strong. literally 10 days ago, according to this data anyway. It's the same for manufacturing. Forecast 47, it came in at 49.3. Now 49.3 is still in contraction, but it's better than expected. That was on the 24th of March. So let's go to the 3rd, which is the first business day of the month. Here it is here. First business day of the month, manufacturing was forecasted to be 49.3. Why? The flash reading came in at 49.3. Flash reading came in at 49.3, and we slightly missed it, 49.2. Not that bad. PMIs were expected to be greater than 50, 51. Oh, that's prices, actual PMIs. Sorry, it was expected to be slightly better, 47.5, came in at 46.3. Now, if we go to the 3rd business day of the month, was that, what date is today? The 5th. Okay, so it's on the 5th. Today, I think it was. Was it, or was it yesterday? Yeah, it was today. So these are, so here it is here. A moment ago, we looked at the composite. It was expected to be 53.3, came in at 52.3. These are minor weaknesses, right? But they're weaknesses. And it happened inside 10 days, 2 weeks. And this is really important to recognize. And I'll tell you why it's really important to recognize. Let's say I'm a bank, right? I'm a bank. Deposits come in the door. But depositors are diversifying their bank accounts. Anyone that has over and businesses, anyone that has over 250,000 are now splitting it up into like 10 different accounts because they want to make sure that they're insured. If anything happens to the bank, they want to make sure the money gets back. So deposits are flying into this bank, they're flying into this bank, they're flying into this bank. And all these banks are seeing deposits flowing back the other way because each different bank has the same problem. There are depositors that are uninsured. Look at Western Alliance today. They came out and said that their deposits, fully insured deposits, is now 66%. Massive increase in 2 weeks. Why? Deposits went out the door, came back in, different people. Essentially what's happening is, even if net deposits don't change, right? So let's say a bank has $100 in deposits. Let's say 50% of those sent out their deposits to another bank and 50% came back, like the other $50 came back. You still have 100, but they're different accounts and there's a lot of volatility. And you have no idea when the next guy is going to call their money. So let's go back to Silicon Valley Bank. People realized 85% uninsured deposits. Everybody went to take their money out. In one day, they had 43 billion withdrawals. They didn't have the cash. So what do you think banks are going to do? Well, let's go back to what banks can do when deposits come in the door. So a deposit comes in the door. They've got expenses on those deposits. What can they do? They can put it into the ORP, the overnight repurchase agreement. And essentially, they'll put it in today, and they'll collect it again tomorrow. And at an annualized rate, they'll get the Fed funds rate, 4.75 to 5%. They can lend it out. Somebody wants a mortgage, they can send out a loan, or they can buy long duration treasuries, right? So both of these would be more of their security portfolio, and this would be their loan book. So if you don't know if deposits are going to come or go, are you going to lend out something for 30 years? No, you're not going to do that. Are you going to put it into long duration? 1, 2, 3, 10 years out? Nah, you're going to put it into the overnight repurchase agreement. You can see it here that it started to increase as deposits came in the door. It was sitting in the overnight repurchase agreement because banks didn't know what to do with it. What does that mean? Well, it means that there's no loans going out. Credit collapses. Is credit collapsing because the household can't afford a loan? No. Is credit collapsing because there is no willingness to borrow? No. Credit's collapsing because the banks are not willing to lend. And the banks are not willing to lend because they've got so much volatility in their deposits. What does that end up feeding into? Jolts, job openings start to go down because there's uncertainty in business. So you have this sharp jab to the heart of the economy in the very near term. But it's not caused because of credit quality or over leverage, and then you have to have a big, massive deleveraging in the economy and it starts to contract. It's happening because of the volatility in the banking sector. And the main takeaway is the Federal Reserve are offering a facility at par to banks to service deposit outflows. So the banking sector is still going to function fine, but there's not going to be loans in the near term until that volatility in deposits die down. So in the very near term, we're likely going to start to see an awful lot of data miss. So you're seeing early indications, ADP, the private data for jobs comes out, forecasted 200,000 comes in at 145,000. Why? Well, people aren't going to hire in the near term because spending is going to slow down because there's no credit expansion. Okay, fine. You've seen it with jolts. What are jolts? These are job openings. We're expecting 10.4 million. People are opening less number of jobs in the near term. So in the very near term, yeah, there's a big risk. There's absolutely a big risk. But is it terminal like a global financial crisis or a deep recession? No, it's more manufactured. And the main takeaway is you can't have higher rates. You can't have higher rates. And that's sort of what my view has been all along. Now, I thought the US government was going to blow up first. This is further confirmation that the household has tons of cash, too much cash, because the fiscal stimulus, sending money out to your bank, $2 trillion in excess saving. We still have 800 billion in excess cash savings. Until that number goes negative, I don't see a significant recession on the horizon. Household consumers still in great shape. Once the volatility in banks dies down, the economy will continue to weaken. But once the volatility in the banking sector dies down, and I think they're already largely de-risked, but once that volatility starts to die down, I think you're going to start to see probably a little bit of a resurrection. I think we're still going to be in that slow growth environment. In the near term, it's going to be like a bit of a heart attack to the economy. And then the next 1-2 months, you'll probably start to see a crawl back. We'll see what happens with the Federal Reserve. I mean, look what the market's pricing in. The market's pricing in that the Federal Reserve royally screwed up. And by September of 2024, which is a year and a half away, we're going to go from 4.75 to 5%, all the way down to 2.5 to 2.75%. That's a hell of a lot of easing. That's a hell of a lot of easing that the market is pricing in, literally cuts right away, the whole way. So it'll be interesting to see how this all plays out. But the main takeaway is there is no tolerance for high interest rates. If the Federal Reserve if they really felt like there was a tolerance for high interest rates, they wouldn't have acted as quick as they did. And again, look, I really don't care what you want to call this. I really don't care what you want to call this, quantitative easing. It doesn't really matter. Where's the capital flowing? They're given a loan at par. It's going to go into money market funds if depositors take their money out and put it into money market funds, which is T-bills, or it's going to be savvy banks like M&T put it into duration now at these rates. It's still flowing into bonds. So the Fed's balance sheet went from, like, you got to look at where we are right now, 8.7 trillion. That's where the balance sheet was in October last year. So all that quantitative easing for the past 6 months, all up in smoke for 6 months in the space of 2 weeks. So that move alone, like, there is no room to raise interest rates as fast as they did. And I think it's going to come at a much bigger cost. If the economy slows down, unemployment does increase, what's going to end up happening is tax receipts are going to decline at a faster pace. If tax receipts decline at a faster pace, it's 56% of the government's income. They're already screwed. They're already running a $1.5 trillion deficit, and they're expecting to do that for the next 75 years, according to the budget office. So you can't have your cake and eat it, essentially. And I think this reaction from the Federal Reserve shows that they're willing to inject liquidity at a moment's notice. And that's ultimately what the expectation is. This is a liquidity-driven environment that can't change, and inflation is part of the solution. So that's where I think we are. There's, in the near term, it's really difficult for me to really care too much about near-term moves, because there's a lot of value out there and there's a lot of stuff that's incredibly overvalued. Like there's a list I have. This is the top list. I would like to buy all of these companies, but let me just show you this company here as an example. It's a company called Exponent. Let's look at this on a log scale. This is almost like Bernie Madoff's fund. Have you seen anything more linear than that? Literally only goes up. Now, it looks great, but there's been a number of 50% decline. So I would say 99.9999999% of people that are investing wouldn't have held it for that long, even though it looks like it would be pretty easy to hold. This here is a 38% decline. I think once there's a little bit of volatility, a lot of people run. But when you look at something like Exponent, problem is these are really good quality companies, and you can see it in the rate of returns, you can see it in their balance sheets, you can see it in their growth. Like, these are companies that really generate outsized returns. Well, okay, so that's a little bit of an anomaly, but even prior to that, let's get rid of that. Even prior to that, look, this is generating in excess of 20% return on its invested capital. It's really high. Same with equity, return on equity, really high, like good quality businesses. But over the past 10 years, the market knows it's a good quality business, and it's really, really, really hard to buy these. At least 4x of the performance has come from multiple expansion. This is a price to earnings multiple. It's just gone vertical in tandem with expectations. We're in a new era where these multiples need to come down. So these are all really, really, really high quality companies, but they're bloody expensive. And it's really hard to buy them at these prices until you start to see a more reasonable price. When you look at something like Lumentum, Lumentum is a really, really, really interesting company. And everybody thinks it's a useless company. Now, let's have a look at the share price, because this is the first thing that most people look at. When we have a look at the share price, the first thing that people look at is, oh, it must be in a lot of trouble. I mean, like, the share price has gone down. It's trading at about 9 times earnings. And I think the most important takeaway is when you're investing in something, having a little bit of a longer time horizon to allow the fundamentals to be fairly reflected in the price makes a lot of sense. Like, hopping in and hopping out can be a little bit challenging. So let's have a look at Lumentum really quickly. A lot of people are concerned about Lumentum because there was a tweet, which I don't think has been confirmed yet, by the way, but there was a tweet out anyway from an analyst that said that Lumentum was going to lose market share on the iPhone 15 for VCSELs. And these are like cameras that for facial recognition and stuff like that. And this is part of their consumer and industrial segment. Now, this came out more recently. Look at the revenue. This is the revenue of that segment. Minus 31%. So October into December, minus 31%, minus 22%, minus 11%, plus 5%, minus 30%. It's in structural decline. It's gone from 190 million down to 64 million. And at 64 million, its weighting on revenue is only 12.8%. And now the article comes out that Apple are going to purchase a little bit more from Sony. So previously, 50% of all iPhones had a Lumentum component. The iPhone like 14, 50% of the handsets had a VCSEL from Lumentum. Now it's going to be 40% or 30% in around that region, according to this tweet. And Sony are going to take up the slack. And part of the reason for that is Sony has better battery life. So it's not really about quality. It's about preserving battery, probably for other features. So when you're looking at this, you're like, okay, 12.8%. They lose maybe 20% of one customer's orders. They also have Huawei and other companies in this segment as well. So it's not the entire segment. It's probably like, maybe 10% of the entire segment, 5% of the entire segment. Does it really matter? Not really. It's only 12.8% of the revenue. And look what's happened to telecom and datacom. It's gone from 216 million to 384 million. It now accounts for 75.9% of the revenue. So what is telecom and datacom? This is in opcoms, which I'll go into that in a second. Opcoms is optical communications. Both of these are optical communications. And then there's lasers, commercial lasers. So opcoms is predominantly telecom, datacom, and they're selling to, we were invested in Charter for a brief period, and Charter Communications said what? They're going to increase their capital expenditure $100 per subscriber. And what were they doing? They were comparing that to Comcast, who were spending $200 per subscriber. All of these different companies are actually increasing their capital expenditures right now, which means that medium to long term, we should see telecom and datacom continue to grow. Over the past couple of years, what have we seen? And by the way, that is maintenance capital expenditure for those companies. It's maintenance. It's just to maintain operations. Look at the growth in this segment. 23, this is quarter over quarter. 23, minus 8, 15, 27, 7, 6.6. It's growing at a fast pace. That's a segment. So what do their products do? It's more B2B. It's not actually B2B to C. It's they sell products to help their customers speed up the rate at which they can process data and stuff like that. Data transfer, all that sort of stuff. Like everything that's scaling up, even LiDAR in self-driving vehicles, they sell LiDAR, all of these sort of things, all of these trends, commercial lasers for industrials, telecom and datacom for data processing and transfer, all of this sort of stuff. These are very early within their bigger picture trends, right? So for the next decade, those markets should do very well. And this is predominantly where their market is focused, and it's still incredibly strong, and it's now 75.9% of their entire revenue. At the same time, you also have lasers here, which is a smaller segment. It's only 11.3%, but it's also growing. So you have a situation where 87% of your revenue, telecom and datacom, is growing double digits year on year. And the drag from the slowdown in consumer and industrial is really in the rearview mirror. The base effects are gone. You've gone from 42% weighting of revenue down to 12. The base effects are gone. It's not a problem. But the market looks at that and they're like, holy smokes, Apple's moving away from VCSELs belonging to Lumentum. This is terrible. When you segment the revenue, you realize it's not terrible. Okay, so that's part of it. The fundamentals of the business are still very strong. Their clients are ramping up capital expenditure, so growth should be fine in the largest segment of their business. Okay, from a fundamental perspective, the company should be fine. So let's go back now. Let's go back, receives notice of termination. So Lumentum was to acquire a company called Coherent. C-O-H-R, Coherent, this company here. And they were to acquire this company. And before they were to acquire this company, what did they do? They raised some debt. So they've got convertible notes, 2024, 614 million, 2026, 1.065 billion, and 2028, 735 million. So they raise all this money, and they raise all this money in anticipation to acquire Coherent. And then on the 25th of March of 2021, Coherent give them a notice and say, hey, listen, we don't want to go ahead with it anymore. So they cancel the deal, and Coherent end up merging with IIVI, another semiconductor company. But when they canceled the deal, they had to pay out 217 million termination fee. And you can see that on the balance sheet. If you go over to Lumentum, so this here, you would say, damn it, these guys have raised some money for a deal that's not going to go through. Now they have to pay interest on it. Okay, so part of it is they're going to end up in a situation where they're going to get, where is that? There it is there. They're going to get 217.6 million termination fee. If you go to financials, you got a balance sheet, not balance sheet, income statement. You will see it's 199 million. There it is right there. Merger and restructuring charges in 2021. Okay, the net amount, so there might be some restructuring charges, but they received the 217 million there. There it is right there. It's factored into the EBT. It's factored into the earnings, net income. That's it right there. They received that money, but they're stuck with this debt on their balance sheet, 2.4 billion, and they're sitting on cash. Like they've got, what's their cash? Like 1.5 billion, 1.68 billion. So you have all this cash that they don't need. Here's where it's bloody genius. Well, not genius, just circumstantial. They got 217 million here. They raised money and they're paying interest. These are convertible bonds. If you don't know what a convertible bond is, whoever issues the bond has the right to convert the debt into equity, but there's usually a condition, right? So in this case, it's a 30%. So if the conversion price is $99, the condition would be 130% above the conversion price is where it can convert. So they issued these convertible notes at $99, $131, and $60.62, but they can't convert unless they're 130% of the conversion price. What does that mean? Well, it means like if we go equals, there's $1,000 bond divided by 99, each $1,000 will convert into 10.07 shares at $99 essentially. So the dilution would be a lot less, but it can only convert at $129. So this is going to retire in 2028. This is going to retire in 2026. And this is going to retire in 2024. It's actually December 2023, later this year. Look at the interest expense, right? So these guys are paying 0.5%. They may have to pay this note back. It's fine. They have the cash. They have the cash flow. They got 217 million. They reinvest some of that. But they have an asset. This is an asset. It's got a fixed interest expense of 0.5% on the 2028 note. They got a fixed interest expense of 0.5% on the 2026 note. And they got a fixed interest expense on the 2024 note, which expires this year at 25 basis points. Why is that now an asset? Let's have a look at their balance sheet. As of December 31st, Cash and cash equivalents, 383 million. Commercial paper, short-term bonds, up to 270 days, usually reflects short-term interest rates. Money market funds, short-term bonds, they're all yielding about 4%. US treasuries, so these are all, so if we go down a little bit further here, you'll see $880 million of this is due inside the next year. All of that money on their balance sheet, the vast majority of that money on the balance sheet is sitting in vehicles that's going to generate about 4% interest. So not only did they generate 217 million here because it was terminated on Coherent's part, they're stuck with all this cheap debt. And the cheap debt is earning 4% and they're only paying half a percent on it. So we have a situation where the fundamentals, if I talk to anyone about Lumentum, what's the first thing they'll say? Oh, that's terrible. It's terrible because they just lost Apple as a customer. They didn't lose Apple as a customer. They lost a percentage of the revenue on the iPhone 15 for VCSELs, which is a very small segment of the revenue. If we pop on over here, VCSEL should segment the revenue. So OpComs, we have consumer and industrial market. Here it is here. In the consumer and industrial market, our OpCom diode laser products include, okay, whatever. I just want to show you guys VCSELs. There it is right there. Vertical cavity surface. So this here is the segment anyway, consumer and industrial. It's not a problem. The market might not price it today, but what they're doing is they're acting as a better bank than Silicon Valley Bank. They're more experienced. They're borrowing at a lower interest rate and they're lending out at a much higher interest rate. Short duration. They're killing it as a bank. Their business is still incredibly strong and growing. And the base effects of the weakness, which is causing the share price to go down in the near term, is gone. So I think the way I look at this is, like as Joel Greenblatt says, is over a reasonable time horizon, the market will agree with you. We just don't know when. So at 9 times earnings, 10 times earnings, like this is trading at 10.5 times earnings. At 10.5 times earnings, a business that's about to see a step function in its growth because telecom, datacom's growing at a faster pace, I think that's a bloody good deal. It's very low risk because they got tons of cash. Okay, part of that cash might be gobbled up because unless we see by December Lumentum trading at 78.81, that note won't convert, and then they'll have to pay 614 million to settle that note. That's fine. They've got 1.6 billion, but while we wait over the next couple of months, these guys are paying 25 basis points to collect 4%. It's not bad. And so that's not really a problem at all. So I think the fundamentals of Lumentum here are fantastic for anyone that had a reasonable time horizon. Listen, I'm going to get into some of the questions because I could talk for hours here. What are my thoughts about the voting for the annual meeting of Warner Bros? I think most of it's about executives. Most of those, I'm really kind of indifferent. I look at all of them, but most of them I'm kind of indifferent. I usually just vote with the board. A lot of the time I agree with it. So it's like, we got one recently for Citigroup. I think if you check your email, I think like last week we got one for Citigroup, and most of it's about approving the current board of directors. And then there's stuff like on executive compensation. When is there a review? Once a year. I prefer once a year than once every 3 years, right? Because there's a lot of uncertainty over 3 years. I mean, so that's like most of the time I look at those votes and I usually vote with the board. Can I talk about Overstock, which is down 10% today on no news? Is the e-commerce furniture space doomed post-COVID? Look, I just added more to Overstock. It was up 5% yesterday while the market was down. Why was it up 5% yesterday? I have no idea. I looked at it yesterday and I said, why is it up yesterday? No idea. Look, the way in which I look at Overstock is, look at the news that came out yesterday, which is why I think it popped a little bit. I'm not sure. Big Global is doing, so these guys are CBDC platform. Just as an example, CBDC, right? So right now you're probably getting the furniture business at a discount today, including the cash. You're not paying anything for the for the mid-EC portfolio. And I think that's a mistake, and I think it'll be fairly reflected in time. If you look at T0, it's the only securitization portfolio left. BlackRock came out recently and said there's massive underinvestment in tokenization in the US. Massive underinvestment. There's only one platform in the US that's SEC regulated. It's a company called T0, and we own 55% of it. But Big Global is another one. These are all priced at zero, but they're incredibly valuable assets. Nigerian local currency is doing, as of right now, they're ramping up CBDCs over Nigeria using BIT's platform, $22 billion, the equivalent of about $50 million, which doesn't seem like a lot. $50 million per year is what they're doing over in Nigeria using CBDCs. It's very early in its ramp-up stage. Big Global collect a commission on that, like Visa. So this is a company that actually generates real revenue. Nigeria is one country. They've got a number of Latin American countries as well. And as a lot of these countries move towards CBDC platforms, one of the premium companies in that space is Big Global. And it's scaling up. But these businesses have tremendous scale. Because if Nigeria ends up doing $5 billion in transactions on CBDCs, it's just commissions that they're rolling in. It's not like it's, as it gets rolled out further and further and further, it has more scale for Big Global. And so these businesses are real businesses that generate cash, able to raise money. Look at Grain Chain raising $29 million. We've got about a 20% stake in that business. It's pretty damn exciting as well. And so you have all these businesses that are raising real money. So you could ask yourself the question, who on earth is financing these deals? Why would they finance them if they're worth zero? $29 million? It's quite a big investment. 20% ownership, ICE Markets and T0. These are not small investments. Maybe it's small to ICE Markets because it's like a $50 billion business, but generally speaking, these are not small businesses. They're scaling up. And just like we went over a moment ago with Lumentum, people have no idea anything about Lumentum. People are selling Lumentum because of Apple news. But when you segment the revenue, it tells a completely different story. And I'm pretty sure that if you were to look at this in the next 3 years, net, is it going to outperform the market? I would say there's a very high chance it is because it's growing, it's profitable. Circumstantially, their income is actually benefiting because of the debt that they have for the reasons we mentioned a moment ago. All of these reasons come together, fundamentally speaking, it's doing fantastic, absolutely fantastic. It's not fairly reflecting the share price today. Overstock's a little bit more unique because Medici Ventures is buried inside of it. It's got nothing to do with furniture, absolutely nothing to do with furniture. Sometimes you have like holding companies, like you look at Porsche. Remember you had Porsche. It was a holding company that owned Volkswagen and it owned a couple of other auto companies. They're similar, right? They're still like Porsche. Okay, the actual company was owned by Volkswagen, but everybody recognizes Porsche. So if you're only going to peel the first layer, you know Porsche is a car company. Inside there, if you looked at its book value, it was worth far more than what it was trading at. It was trading at a massive discount to its NAV. Why? Because it's a holding company. People don't realize what's inside there. They cannot unlock that value if they sold those Volkswagen shares onto the market. Then the company was worthless. But my point being is, you can understand that when you look at something like Porsche, you can understand, okay, inside there are some other assets that are in the automotive sector. This is a furniture business that's doing incredibly well in a very difficult market environment. All their peers are losing tons of money. These guys are about free cash flow even on a year basis as of right now. Pretty bad market environment. But they're moving into different segments. So going from value to luxury and different geographies. Doesn't cost them much money. It's pretty much a drop shipping business. So the business itself is weathering the storm really well. They'll come out the other side fine. Bed Bath & Beyond, all these other companies will have to go through Chapter 11 restructuring because they've got too much debt. Overstock have no, well, they have a little bit of debt, but they've got a lot of net cash. They've got no real inventory, right? So what's a big problem with a company like Wayfair? Well, they hold some of that inventory, and ultimately, if they can't sell it, it's going to cost money. It's going to go stale, like in terms of trends and fashion and all that sort of stuff. They have to liquidate it, meaning their margins get compressed. Overstock's not in that situation. They get 3 to 5% operating margin, and it's just really a revenue player. So it's scalable. So the online furniture business is going to be really dependent on what happens in the housing market. But beneath the surface, there's so much value there, and it will be unlocked. It will be unlocked, whether it's through spin-offs. If you look at a company like, is it IAC? Was it IAC? No, it wasn't this company. Was it this? No, it wasn't this company. Is this Barry Diller's company? Let me see. Barry Diller. I think it was IAC. IAC. Yeah, it was IAC. Okay. So IAC share price is down. Okay. Obviously, most stuff is down right now. But check this out. These guys had a bunch of businesses inside that they spun off and created value for. So if you hold IAC for the past, I don't know, since 2020 or whatever, you've made 18% on holding IAC. But IAC spun off Vimeo, VMEO, which created shareholder value. Now, they spun it off at the best possible time, right at the top of the market. Doesn't really matter. Shareholders of IAC unlocked some value and they were given some shares of Vimeo. And so Vimeo ends up going down 99% or 93%, whatever. But if you took that and sold it, you got more cash and you can funnel it back into IAC. What I'm trying to say is inside these businesses are assets that could be spun off into independent IPOs that create shareholder value, because now you've got shares, equivalent share value of a company called Vimeo, equivalent share value of IAC. That's how you unlock the value. The market rates it based on that market environment. And so with Overstock, it's going to take a couple of years. I mean, T0 is really the flagship one, but there's lots in there that are really exciting. But T0 is going to need a couple of years to grow. And then when it grows, I think there's a possibility of it spinning off. But I think people are starting to wake up to the idea of T0 because BlackRock were talking about tokenization. It doesn't take very long to realize, yeah, there's other companies that focus on tokenization, but they're not SEC regulated. There's only one company in that space that's SEC regulated, and it's a company called T0. So it's worth, in my view, it's worth a lot of money, but it's just going to take some time. I'm not really worried about it whatsoever. That might be, might be surprising to hear, but like you look at something like Transocean. When I first got involved in this, it was down. Well, it went up and then it went down, but it was down like 50 or 60% at one point. And there was a real chance it could go bankrupt. But the residual value for the common equity holder was double what I paid for it. So I was like, look, if it goes bankrupt, I double my money. If it doesn't, I can make a multiple of my money. And so far, look, it took quite some time. Like, look at this here. It's like almost 2 years of nothing. It finally recovers. It doesn't go bankrupt, but there's still a lot of uncertainty because day rates haven't increased. It just goes sideways. Day rates start to increase and then it starts to take off. It's breaking out, probably back testing before we push higher. But it takes time. It takes time. The markets, like, you look at Warner Bros. Discovery, just as an example. Everybody told me that Warner Bros. Discovery debt's a problem. How is Warner Bros. Discovery's debt a problem? 14 years average maturity, 3.4, was a 4.3% actually. 4.3% interest expense, which is actually going down because they're paying off some of that debt, about $2 billion a quarter. And at the same time, the revenue is relatively inelastic for their direct-to-consumer business. So, I mean, like, the market, like, when you look at the fundamentals might be solid at a fair price. The market can price it lower, and it might take a year or two. It might take some time to unlock value. Like, one company that I had to have extreme patience for is a company called Cameco, 4 years without making a dime on it. In fact, 4 years later, after purchasing, it was March 2020. It was down 30% on the position. Bought some more, and then it just started to work out. But it took some time. That's why a diversified portfolio makes sense. And I hate to say it, but over the past couple of months, the reason what's keeping us in the game is sort of shorter term sort of investments. Like more recently, we were talking about Jack in the Box. Jack in the Box is up 20% in a couple of months. We had the Taro company, 38% in a couple of months. And then we had Lennox International, it was like 34%. Like a lot of these positions, we didn't even hold for a year. And we can do that because we tax loss harvest in the end of last year, and we carried over as much of those losses, unrealized losses from last year. So we can afford to realize some of those gains on a short-term basis because tax loss harvesting from last year. But a lot of these shorter-term plays have generated enough income to offset the bigger downside on some of those other companies, and it's just a matter of waiting patiently. That's sort of the way in which I'm looking at it. Like right now, I'm looking at Baxter. Baxter is doing okay today. One of the few probably, but it's up 3% today. Baxter started to buy it at, I think, 48. I think I don't know. You'll see it on eToro anyway, but our average cost, I think, is 44, 45. I think this is worth in excess of $80 per share. When you spin off the renal care company, which is going to happen later this year, and you re-rate that relative to its peers, plus you segment those globally, what do they call them? Global business units, GBUs. When they spin off and management are responsible for the P&Ls, you get margin expansion plus the 5% reduction in staff. This is worth, in my view, I'll say I think it's worth in excess of $100. I'm okay paying 45 and waiting patiently. It could go down lower. I mean, like, look at Crocs. I started buying Crocs at $100. I thought $100 was good value for Crocs. It went down to 48. Now, fortunately, you find a good company, you just buy more, and we bought more. But it's with Overstock, it's definitely testing my patience. But the fundamental case hasn't really changed at all. If anything, it's gotten stronger, because when I first invested it, like increased at a position back in early 2022 is when I increased it significantly around March. It's what was I going to say? I lost my train of thought. It was, ICE Markets didn't have a 20% ownership stake. That came later last year. So that further improves it. Ronnie's asking, is the stream froze? It shouldn't be, Ronnie. Stream froze, or is it just me? It shouldn't be frozen. Let me know, Ronnie, if it's frozen. It shouldn't be. Okay, so that's my view on Overstock. I mean, I think we're all experts on Overstock, but the share price is really, it's definitely testing my patience for sure. Another thing is we haven't got our distribution yet from Zim, or at least the last I checked, we didn't. So today Zim is what? It's down 9.72%. Yesterday it was down 16%. Why? Minus 16% yesterday, minus 9% today. It's about 25%. So we get a dividend distribution, which we get on the 4th, which is the ex-dividend date. It's a 25 rule according to NASDAQ, is it? But we would get $6.40 in dividends. So we already received $2.95. I'm still waiting for eToro to pay us out the $6.40. I was hoping we would have got it on the 4th, so I could put it into Roche, I'm not sure. It's another company I want to build out, but anyway, that's for another day. We're still waiting on that dividend distribution. That'll pop up in the next day or two. You'll probably see one day, which is randomly maybe up like 1.5% or whatever. That's just receiving our dividend finally. But the way in which I looked at Zim is the liquid cash value of this company is $35. We paid $22. And so far, we've been paid out $9.35 in dividends, plus $17.65. We're at about 26. What are we at? 26. Yeah, we're at $27 as of right now, exactly. So we're at 27. I still think there's more upside. It's probably still a little bit more on the upside, but we're up about 20% so far on that. We just need to get that bloody dividend so we can reinvest it. So Zim is being down. Why is it down? Normally what happens when you pay out a dividend, if you listen to the textbooks or whatever, if you read textbooks on finance, they say a dividend on the ex-dividend date, the share price will drop the equivalent of the dividend value. Normally that doesn't, I normally don't see stuff like that. Generally speaking, a company that produces 2% dividends is not really going to impact the overall balance sheet. But when you're paying out $6.40, which is 25% of your market cap in one dividend, what's happening? Well, the liquid cash off your current assets is down massively. So that's ultimately what's playing out here. And it happened over here as well. That was $2.95 in dividends, but there was also some challenges with the market. Anyway, so right now, as of today's price of $17.65, factoring in our dividends, we're at about $27. I think it's probably worth somewhere closer to 35, maybe more, but I'll be closing at 35 if we can get there. Outside of that, so yeah, Roche, or not Rogers, but Roche, I'm not sure how it's pronounced. This is a company, healthcare seems to be doing very well. This is a company we're looking at reinvesting the dividend in. So I'm also looking at possibly looking at other positions where I might reduce exposure to build out Roche, however you want to call it. This is actually a really, really, really nice business. Everything's stacking up as well. So I'm waiting for, obviously, from a technical perspective, a little bit more confirmation, and then I'll increase the exposure. I'll add exposure. Today it's up. Yeah, it's a pity. I wish we had the dividend distribution, but it is what it is. Outside of that, I don't think there's anything else I wanted to talk about. Exelixis we've had really good success with biotech in the portfolio. So back in 2020 and 2021, most of our returns came from oil and gas. So oil and gas, financials, and biotech. That's where most of the returns came from. And then we had some smaller positions, like we bought into Jumaya. Jumaya was a small position, but it went up like 500%. We had some small positions anyway, but most of the portfolio was invested in oil and gas, financials, biotech. We've had really good success. So BioNTech, bit challenging. Neurocrine, we got out a little bit less than flat. But, and this will be important because I'll tell you about Exelixis in just a moment. But you look at companies like Alexion Pharmaceuticals. Alexion Pharmaceuticals was bought out by AstraZeneca, 65% premium. GW Pharmaceutical bought by Jazz Pharmaceutical, 100% premium. Regeneron was the biggest position in the portfolio at the time. I think it was about 45%. Even Bristol Myers, I think it was about 15 or 18%, decent sized position as well. So net, we've done really well in biotech. We've got an average cost, only a small position, but we have an average cost in Exelixis, 1660. So what do we look for? I'm not a scientist. And I think there's a huge opportunity in biotech pharmaceuticals because people are constantly looking for their core competence, but it pushes everyone into really simple businesses. These are really simple businesses. They're not difficult to understand. The science behind it's difficult to understand, but you don't need to know the science. You just need to understand accounting. So when you're looking at pharmaceuticals, there's a huge amount of R&D, right? And this R&D produces IP, intellectual property. Most people go into the speculative stuff where there's huge R&D expenses. There's a chance of striking it rich, but it's a low probability. And either you make 10x your money or you lose 100% of your money. I don't like that. I like companies that invest in R&D, gain IP, and then they go into the commercialization phase. So here is your essential commercialization approvals. Their flagship drug was approved in 2016, and it started commercialization. I didn't buy it on the lows. I still think I'm going to make a lot of money. I don't need to take on all that risk. So what's the opportunity that exists here? Well, the IP will protect them against competition unless the competitor comes out with a better product. But here's the thing. This is a really interesting thing. In biotech or in pharmaceuticals, you have 3 trials, and it takes about 5 to 7 years, right? 5 to 7 years to go through 3 trials. So it'll start off in mice, rats, and then it'll eventually get up to humans, and then it'll get FDA approved, and then it'll go to commercialization. It takes about 5 to 7 years. It takes a ridiculous amount of capital. So there are your barriers to entry, risk and capital. You get IP, and if it's a generic drug, you get 20 years protection. And if it's a rare drug, rare disease like Alexion Pharmaceutical, you get 30 years and you get tax benefits. So you don't pay tax on the revenue that comes in from those rare drugs. So if you look at Exelixis, they've got patents that are very early. They're very early in, like, they're not very mature patents. Look at something like Bristol Myers. What's the problem with Bristol Myers? 50% of the revenue, 60% of the revenue, the patents expire in 2026. Do margins compress? Is there more competition? Because I could go into the market and start producing those drugs. Different name, of course, but I can still produce them. There's no more protection. And so these guys have plenty of protection, and they got plenty of cash flow, and their balance sheet was clean as hell. These guys had like 1.3, 1.4 billion in cash. It's only a $5 billion business. It's a little bit more now, but these guys had $1.3 billion in cash and they had no debt. So they have $1.3 billion in cash. They're ramping up their renal cancer drugs. They're repurposing it into thyroid cancer drugs. And then they've got other pipelines that are starting to come through. But that's the vast majority of the revenue. As they're going through this commercialization phase, you're seeing pretty decent top line growth. You're seeing pretty decent bottom line growth with sort of margin expansion over the next couple of years. And that all flows into really strong cash flows. They've got no debt, lots of cash, plenty of cash flow, a lot of protection. And if another biotech company is to compete with them, again, it's going to take 5 to 7 years. It's going to take a lot of money, and there's a lot of risk associated with that. So you got some sort of protection. What did they decide to do? They decided to buy back $500 million, 500 or 550. They decided to buy back we're 550 million. Okay, so they decided to do a buyback 550 million. This is not a big business. It's 5.2 billion. It's spitting out tons of cash flow. They've got too much cash, so they're going to start buying back their stock. The natural buyer of the stock is the company themselves. I think it's worth in excess of $30. I regret not having a bigger position, but these are the type of companies that we invest in. Alexion was trading at about 8 times earnings. Rare drugs. So what does that mean? They have 30-year patents. They pay no tax on those drugs that they sell. And let's say there's 5,000 customers like that have this rare disease. Well, the insurance company pays for the drug. And because there's only, let's say, 5,000 patients worldwide, the price of that drug is like $1 million a year, or 500,000 or whatever. It's really expensive. It's guaranteed by the insurance company and you get a tax break on it. And that's Alexion Pharmaceuticals' business. Clean balance sheet, lots of cash, very cheap multiple. It wasn't very cheap for Exelixis in terms of its multiple, but they had a $1.3 billion net cash position. So when you backed out the cash, you factored in the growth, okay, paying 20 times earnings is pretty decent. So it's starting to play out now. Wish we had a bigger position, but it is what it is. If we can find more of those, great, but they're not. It's not necessarily that they're a dime a dozen, but it takes some time to they don't come around very often. Today we had Johnson & Johnson come out with Johnson & Johnson agreed a settlement. Was it on the talcum powder? So while the rest of the market's down, 3M is not. They agreed, I think it was $8.9 billion, but there it is there, $8.9 billion payable over 25 years, right? So remember we were talking about the risks associated with 3M, the earbuds, 250,000 cases, all that sort of stuff. Let's say it's like $15 billion payout, 20 billion. Some people are assuming it's 100 billion. I don't think that's the case, but it'll amortize over a number of years. Like in this case, to Johnson & Johnson, 8.9 billion over 25 years is what? 356 million a year. And here's the thing, with inflation over the next 25 years, 8.9 billion, it's worth nothing. Present value of cash flows, right? Present value of cash flows. Today, it's worth more than it is in 25 years. They just struck a fantastic deal. So 3M, I think one of the reasons why it's not down today is Johnson & Johnson coming to a resolution there. Because the market is down. Outside of that, I think banks are probably, like we increased our exposure in Citi massively. This is about 9.5% weighting within the portfolio, but this is a GSIB bank. Unrealized losses don't really exist because they hedged out the interest rate environment really well. So one way of doing it was not tying yourself into duration. Another way of doing it is tie yourself into some duration, but hedge out the interest rate environment. Citigroup hedged out the interest rate environment, so the unrealized loss is very small. It's a GSIB bank, so it's held to more strict regulatory standards. So the GSIB banks are fine. And this was selling off pretty aggressively, and we increased our exposure on this sell-off. We sold out of Meta, and we put it into Citigroup, and so far, Meta puts a little bit higher, and I hope to get back into this at some point. But I think Citigroup from here represents better value, at least in the near term. We might close it out and buy back into Meta if it gets down towards 150. Outside of that, I don't think I really have anything else to say. Any surprise with CleanSpark not rallying even harder off its lows when Bitcoin rallied from 16,000 low to 28,000 lows, I guess, to high 28,000. How do I see price discovery happening for CleanSpark, higher Bitcoin puts, CleanSpark in a good spot? Yeah, here's another thing. Markets are not efficient. Anyone that said the efficient market hypothesis makes sense, I would say they're new to investing. I really would. And they don't really know what they're talking about. Because in 1987, we had a 20% drop in the index in one day. How is all the information in the market? Look at these banks. Silicon Valley Bank, anyone that read the 10K filing knew that they had massive duration. It's all disclosed in the 10K filing. The market's known about all the information was available for months before it collapsed. The unrealized losses at the bank were so big, it had no equity. It was a bankrupt bank. It was a zombie. The market would have known. I didn't analyze the bank. I didn't know. But anyone that was following the bank probably did know. Many people did figure it out. But it wasn't fairly reflected in the share price. The efficient market hypothesis is nonsense. The reason why I want to bring that up is having a look at CleanSpark's board of directors and investor relations. A little bit of concentration there. I give the management a hard time from time to time, but it'll keep them honest. CleanSpark news, maybe it's in here. CleanSpark news, just one moment. I want to show you something. So this is important. This is really important. CleanSpark March Bitcoin mining update. So one month ago, how much Bitcoin did they have? They had 100 Bitcoins. They used the rest of their Bitcoin to buy 20,000 new rigs. This month, for March, they mined 598 Bitcoin, but their holdings increased 96. What did they use the Bitcoin for? Well, they sell the Bitcoin to pay operating expenses. So they sold 502 and they had 96 left over. Let's assume that 96 is profit. Let's pop on over here and have a look at where Bitcoin is trading right now, 28,000. So if we take 28,000, multiply by 96, because they have 96 Bitcoin, they would make a profit of 2.688 million per month at the current hash rate, at the rate at which they're mining Bitcoin. They've got more miners to come online, but at the current rate at which they're mining Bitcoin, at 28,000 and the hash rate, they would make a profit of 2.688 million per month. Times 12, you would make a profit of 32 million a year. Market cap 543 million. It's about 12 times earnings at 28,000 Bitcoin. So you can see that the leverage here for CleanSpark is massive. The leverage to the price of Bitcoin, incredibly profitable. Market cap, why? No, that's the Bitcoin. It's not 500 billion. Market cap, sorry. I was looking at that and I was wondering whether they tapped into the money, because last I checked, it was 200 million. Now it's 194 million. Okay, that makes more sense. So 32 million divided by 194. 16.5% margin, earnings margin. It's not bad at 28,000. So the reason why I like CleanSpark is the potential to generate ridiculous amounts of profit as the price of Bitcoin pushes higher. I follow Cross-Border Capital. I have some of his tweets here. I think he's great. He absolutely nailed liquidity. Liquidity, he was banging the table. His name is Michael Howell. Banging the table last October. He was saying liquidity has reached peak tightness, and then since then it's been easing. All of his indicators, there it is there. You can see that in 2023, the green bars, that's liquidity easing from the Federal Reserve. All of his indicators are suggesting that liquidity is expanding. So as liquidity expands, and you can see it in the price of Bitcoin. I mean, Bitcoin October, November bottomed, and it's almost doubled since then. If liquidity continues to expand, and I'd argue it will, when you look at rate hike expectations, if liquidity continues to expand, Bitcoin price will continue to push higher, be a new cycle. So the reason why I bring that up is, forget about where, like when I bought CleanSpark, I went heavier later last year, and my view was over the cycle 3 to 4 years. You're not going to pick the bottom of an asset that's going to potentially go up 10 or 20x. It can go down, as you've seen, like 80%. And so if we can get close to the bottom, hang on to it for 3 to 4 years, like I think CleanSpark could be worth a hell of a lot more than what it's currently trading at. And you can already see the potential of opportunity here. If we take that 96 Bitcoin that they've stored in their vault, because they've already told us that they're only going to sell what they need for operating expenses, 16% margin, profit margin, 16.5. There's very few companies out there. Now it's volatile, but it's volatile and can also push higher over the next year. So the halving will come next year, but they just bought an extra 20,000 mines. So they'll increase their hash rate to offset some of that. I think it's a great opportunity, but it's also a small cap. Small caps are not well covered. It's quite volatile. And when there's uncertainty, certainly with the banking sector, I mean, if you go onto social media, everyone's going to tell you it's a banking crisis. It's like 2008. It's not like 2008, not even close to 2008. It's a funding crisis. Individual banks are going to go to zero, and that's a crisis. That's a banking crisis for individual banks, but it's not broadly. It's more specific. But there's a lot of fear out there as of right now, but I think it'll be fine. Do I think Bitcoin and gold will remain in tandem? Well, both of them are offering up similar sort of characteristics, right? So the reason I own Bitcoin is, like, I'll tell you, this was my fundamental thesis. I read about the bail-in crisis in Cyprus in 2018, and I didn't like what I read. And it's funny, you listen to people saying, bail in the depositors at Silicon Valley Bank. I don't really like that idea. But that's what they done over in Cyprus. If you had more than 100,000 in the bank, including small businesses, like there's bakeries. If you go on YouTube, you'll find some interviews with a baker that had $2 million or 2 million euros in operating cash flow for the business. They employed like 60 people, and the 2 million that was in the bank was used as operating cash flow for their employees. Well, 1.9 million was bailed in and the bank went to zero and 60 people lost their job. And what was the owner of that business given in return? Worthless trash bank equity. And I was like, that seems pretty hard or harsh. And that was done under Madame Lagarde. And if you go back to 2018, who took over at ECB? Madame Lagarde. And I was like, all right, so what exactly could I own that there wouldn't be sort of like an overreaching government that sort of converts my deposits that I work my ass off for into worthless bank stock that is frozen for 5 years. That's what happened over in Cyprus. And I was looking at gold and I was like, well, gold's pretty hard because the custody issue. If you take it out of the system, it's devalued. If you leave it in the system, you got to pay for somebody to look after it. And then I was like, I don't really want to own gold, to be honest. I'm not a tinfoil hat type guy. There's no yield on it. And then I came across Bitcoin. And here's the interesting thing about Bitcoin at the time. Back in 2018, when I invested in it, the market cap of Bitcoin was only 40 billion. Bitcoin, it was $40 billion. And this was about the best risk to reward you could find. If I was right on this, and people in Europe started adopting some Bitcoin because of the risks of maybe bail-ins, maybe some people would have to lose money before that occurred, or inflation or whatever. If I was a small bit right, the market cap was completely mispriced for a region that has $13 trillion in GDP and $22 trillion worldwide in savings. It's at the margin. It's at the margin that would drive the share price and the value. So I thought at $40 billion, how could it not be a 20x or 25x over a 5 or 10 year period? There's very few risk to reward opportunities like that. But it was gold or Bitcoin that had similar characteristics. But at the time, gold had a $7 trillion market cap. Bitcoin had a 40 billion. Risk to reward, what are you going to choose? I mean, I'm an investor seeking return. I mean, my job is to take risk. Of course, I'm going to take Bitcoin. So I think both of them have similar properties. I think they'll protect against the same sort of outcome, both from a systemic perspective, like bail-ins, but also from a liquidity perspective. Bitcoin's a dumb asset. I didn't expect, I'll be the first to say, if you go back over all my live streams last year on all my videos, I didn't expect interest rates to get as high as they did. I didn't think it was prudent to slow down the economy when you're running a deficit and you've got 125% debt to GDP. And I thought maybe cooler heads would prevail, but that's not what played out. And so it was Bitcoin wrong to drop from 69,000 down to 15? No, it was a fair reflection of the tightening of liquidity standards. And as of right now, as we start easing since late last year, and again, you can call it QE, not QE, whatever, it doesn't really matter. It really doesn't matter what you call it. It's like going back to 2015, 2016, the TLTRO program from the Europeans. We're not doing QE. It's called targeted long-term refinancing operations. Give me a break. You're offering 4-year loans. It's expansionary monetary policy. I don't care what you call it. It's the same outcome. So it doesn't matter whether you call it QE or what. It doesn't matter. If I was calling higher for longer and we need to raise interest rates because of 1980s inflation and we end up with the Fed's balance sheet growing 400 billion in 2 weeks, I would be embarrassed too. So I don't care what people want to call it. It's expansionary monetary policy, and it's fairly reflected in the price of Bitcoin. And I don't think you can get as tight as we've been last October again. I think we're done. And the market sniffed it out. There's some people that are still arguing with what the market's pricing in. Yesterday, Waller came out and said, I hope we don't break anything. I guess the failure of 3 US banks is not breaking anything. But I don't give these guys much credit over at the Federal Reserve. And I think there's good reason why we shouldn't give them credit, because they're not the brightest or the sharpest knives in the drawer. And I think we can see that here. Just as a joke, I decided to share this here. Neil Kashkari, he's still at the Federal Reserve, believe it or not. Kashkari said that he had his own unconventional method for keeping an eye on inflation, and it's accessible to anybody. What is this mystery inflation indicator? There's this large tray of lasagna that I used to buy that used to cost $16 and now it costs $21. And if you read on in that article, he says that the party size souffle has increased in price as well. This is who's setting monetary policy. And this idiot, it's not the first time he said something stupid. April 16, 2018, Fed's Kashkari says fiscal stimulus supports moving ahead with interest rate tightening. Donald Trump cut corporate taxes back in 2018 or 2017. Can't remember which year it was. May 16, 2019. Rate hikes were not called for, and the policy had been too tight 1 year later. These guys are not the brightest or the sharpest knives in the drawer. So when I hear people like Waller come out and say, I hope we don't break anything yesterday, you begin to realize that good effing Lord, the stewards of this monetary system are baked, unfortunately. So, yeah, it's really disappointing. Anyway, the current system can't sustain higher interest rates or tighter monetary policy. It can sustain higher interest rates, but not higher than inflation. And we've seen that already. Interest rates get pushed higher too fast, too quick, above inflation. Banks start to fail, unrealized losses. Part of the reason is too much deposits, too much cash in the system. Ironically, part of it is too much cash in the system. But the net savings, let me pull this up here. Let me just show you where we are actually. Where is it? Fed balance sheet. It's not that one. Where is it? Financial reports, not that one. Partnership population. Okay, I think it's this one here. Is it this one? No, 1 second. It's this one. Yeah, here we go. All right. So what do we got here? Household balance sheet, consumer credit, mortgages, other. So where is the rest of the stuff? I wanted to see deposits. Where are deposits? Household. Where is it? This is not the right one, is it? Financial accounts US. This is household balance sheet. This is not. Okay, here it is. Here it is. Assets, liabilities. Okay. How do I go through this again? Assets. Oh yeah. So if we go financial assets, deposits. So deposits are. This is balance sheet of household and nonprofit organizations. I don't know why nonprofits are in there, but anyway, households. Household deposits. See it at the bottom there? I don't know if you guys can see it, but it says deposits, $18.2 trillion in deposits. If we go back here and we have a look at liabilities, We go consumer credit and mortgages. If we add those up, so other, I don't know why this is in here, but other is nonprofit organizations. Just ignore that. If we have a look at consumer credit, which factors in student loans as well, home equity, everything. If we have a look at consumer credit, home mortgages, you got 4.78 trillion and 12.5 trillion. To combine, what is that, $17.3 trillion. 17.3 minus 18.2, you end up with $700 billion in net cash. If you look at that relative to 2008, in 2008, you had $13.3 trillion in consumer credit down. I didn't check the data that I got that from, but anyway, you'll see it's negative pretty significantly. I don't see a significant recession until we burn through all this cash. And that's going to take some time. Like deposits were 7.76 trillion. So the net cash position in the global financial crisis was negative 5 trillion. Today it's positive $500 or $700 billion. So yeah, we're not in that situation. Cash deposits are way higher. Households, great shape. I know everyone likes to look at without nuance, but households have positive $500 to $700 billion in net cash. They didn't have that in the global financial crisis. It was negative $5 trillion. Leverage and credit quality is much better today. So the Federal Reserve has the choice, the asset suicide for these banks stuck on the long side. I'm not sure. Let me try to read that. So the Federal Reserve has the choice, the assist suicide for these banks stuck on the long side. Yeah, that's pretty much what it is, Ronnie. Actually, it's I think if what you mean is them offering loans at par, which is ultimately the not QE. I don't really care what you want to call it. It's expansionary monetary policy, and you can see it by the Fed's balance sheet. But yeah, that's flowing into another bank. Those deposits are increasing, and you can see it. You can see it here. Deposits have increased. So cash deposits increased. That's the QE. That's not QE. But yeah, and part of the reason was what? You can't inject 3 times the cash deposits in a 0% interest rate environment and then raise rates at the fastest pace in history. You're just going to blow everyone up. But again, the reason why everyone got blown up is because Neil Kashkari's lasagna increased 25%. So because if we all just put $5 a week into Neil Kashkari's lasagna fund, none of these banks would have blown up. But poor Neil. Shocking. Okay, there's some questions. Let me just find it. There is some questions over here, believe it or not. There is a couple. So there's one question that says, what's my reason for buying MTB Bank? Okay, so that was the point of the stream today, just to settle the nerves there. Okay, so Donna Waller asks a question. Let me just do this. So I can put it up on the screen. What do I think about a copper investment? Also, are thinking about investing in Vale, Rio Tinto, BHP. I'm not. So my view on commodities, I think we needed to reset. It's actually a really kind of complicated scenario, commodities. I like energy, but I didn't like the prices. It's starting to get a little bit more reasonable, and I still think there's further downside to go, by the way, because this is more about supply and ultimately demand is relatively inelastic, but slightly weaker, and supply never really came offline. The Russians kept evading sanctions. But with copper is part of this sort of green revolution. So if you believe that we're going to continue in this world of electric vehicles, solar panels, all that sort of stuff, the demand, we don't have enough. I don't think we have enough copper, actually. So it is an interesting long-term play if you believe that the green revolution is actually something that's going to be consistent and persistent over the next decade. It might take a backseat. We've already seen coal power plants come online. Just as an example, politicians are quite happy to bend the timeline there. With copper, I haven't looked at it in a number of years. I actually used to own Freeport-McMoRan. I used to own it. a long time ago. Learned a big lesson in diversification with this one. I had a big position in this, about $7, $8. I think it might have actually been, it was slight lower low, dropped 50%, but then it recovered. I used to own Freeport McMoran. A part of that was about the demand from electric vehicles, solar panels, this movement, like even wind turbines, I think are consuming a lot of copper. It's conductive metal. It's going to be pretty important for the next decade. It's very interesting, but I haven't looked at it. I haven't looked at copper in a while, so I can't really give any more insight. It's just a very generic high-level view today, because I don't know what the demand, inventory, anything like that looks like today. I don't know what production looks like. Production today across the board is completely different to what it was 5 to 7 years ago. Hedging, all that sort of stuff. I haven't actually been looking at it. Looking at healthcare at the moment. You'll see Baxter's continue to buy into Baxter. Exelixis is also being added to the portfolio. And I'm looking at Roche, I think you call it. But I'm also looking at Roche, which is a pharmaceutical company, being more focused on pharmaceuticals in the near term, defensive play. Some of these are very attractive valuation. Broken in the near term, Baxter with the Hillrom acquisition, but could resolve themselves over the next couple of years. Just a game of patience. But Roche is one where it was probably selling off for good reason, but now it's starting to get to a point where it's very attractive for a number of reasons. So that's really where I've been focusing my attention. Haven't looked at Vale, Rio Tinto, BHP, but one thing I will say is just because copper prices are increasing doesn't necessarily mean that they're good investments. A big input cost is also a commodity, diesel, gasoline, whatever it may be, but energy is a big input cost. Right now, it's not going to be expensive to mine because they got absolutely pummeled energy prices, but it's something you need to consider as well. And I do think energy prices will bounce back. So there's a lot of stuff that goes into it. I'm just giving you a very high level view. It's not something that I've focused on at the moment. Schwazi 44. So Schwazi 44 has this to say. Comes across as two. What was the reason behind closing international distribution services? Because of BBC report about potential administration. Lots of companies I look at in the UK right now appear quite cheap. Do I think this is warranted given the macro or a field of opportunity? So with IDS, it's a mega cheap company. It's a really, really, really cheap company. But the problem with international distribution services is there's two parts of the business, right? You have Royal Mail and you have GLS. And GLS adapted to the higher inflation environment, passed on higher costs, expanded their margins and performed incredibly well, and generated £340 million last year in profit. Royal Mail has a lot of staff. It's very bulky. It's not making a huge amount of profit. And the unions are being a pain in the ass because they want higher wages, but it's not making any money. So 7 strikes last year led to, was it a £100 million impairment in costs for hiring short-term staff? So 7 days missing last year cost the company £100 million. The company came out and said, we're going to split up GLS and Royal Mail. And if the company did do that, fantastic. I'll tell you why it'd be fantastic. Because GLS on its own, if you gave the keys to Royal Mail away and you got rid of that uncertainty, GLS is worth the market cap. Royal Mail would also be pushed out the door with the associated debt. It wouldn't be all the burden of GLS. And so if that did occur, it would be fantastic. And the share price rallied from a low, that was the earnings, where the director came out and said, we're considering spinning it off. Went from a low on that day of £1.74 up to a high of £2.50. And then it started to pull back. And then the unions came back to the table and the management started talking to the unions again. And it didn't make any sense. It didn't make any sense because they were in a fantastic situation. And the situation they were in is, hey, listen, we need to lay off some staff. We can't pass on higher wages because we're not very profitable. And if you don't let us do what we need to do operationally, we're going to give it to private equity and they're going to gut it. They're going to absolutely gut it. 80% of the staff gone. A lot of the routes to rural towns gone. and it's going to be a completely different business. And they were in a real powerful position. And the share price fairly reflected that. It was up about 50%. And then when they went back to the table, I was like, this is a merry-go-round and I can't see an end to it. The company might be incredibly cheap, but can you imagine there's another 7 days of strikes? It's another £100 million. That's a cost to the GLS business. It's minding its own business. It's a completely different entity. And that's part of the reason why they changed the name from Royal Mail to International Distribution Services, because as Royal Mail, the unions were looking at the balance sheet saying you have cash, you have profit. The management were saying, yeah, we have cash and profit, but it's all coming from GLS, and Royal Mail is dead weight. And so there was a lot of uncertainty, and MTB Bank came about. I was like, look, I feel a lot more comfortable owning MTB, and I think we have an average cost of 120 on MTB. We've been buying it pretty much. I don't know. We bought it over a couple of different periods, the whole way down. I think we have an average cost about 120, and I feel a lot more comfortable having the capital in MTB because there's so much uncertainty with International Distribution Services. But I agree, it's a really, really, really cheap company, but it's cheap for a reason today. I didn't think that it was going to drag on this long. I thought we were getting out of it, but unions obviously went back in for a second round, so that's why. Okay, 2 questions. First question, could you give us an update about my experimental virtual portfolio? So I think what you're asking me is, I had an experimental portfolio called the GARP portfolio, and I still follow this, but I stopped allowing it to be followed publicly because I didn't know how to lock the bloody sheet, and somebody kept changing all the formulas and inputting their own data, and it wasn't. And like every time I went back in, I had to change the sheet back again. So I was like, all right, I'm just going to put this on private. So what is this? There's actually a couple of lessons to learn here. Zoom out. Yeah, there's a couple of lessons to learn from this. So I wanted to see if you could change the formula that S&P have to create a passive portfolio that outperforms. It'll take a couple of years. You're not going to find that out in 1 year. In 1 year, you should be looking at adjusted returns. So you'd be factoring in volatility relative to a benchmark, but you'd really want to be looking at total return over maybe 3 to 5 years. And so we're in 1.5 years on this, and it's interesting because it's just tracking 2 of the benchmarks, and it's behind on 1. There's a couple of things that I want to point out. So what was the criteria that went into this? Nothing to do with valuation. We were looking at 5% compounded growth rate over 5 years. That didn't mean like it had to be as smooth or greater than 5%. It just meant like maybe 1 year it could do 12%, 15%, the next year flat, the next year might be down 2%, and then it's up 10%. It doesn't matter. It needed to compound over 5 years of 5% per year. The second thing was margin expansion, at least greater than 0% on gross margins. And the third criteria was, geez, I can't remember. I have it written down somewhere, but the third criteria was something else. I can't remember off the top of my head. But there was another criteria. Oh, yeah, there was, you couldn't have more than 35% of the portfolio in one industry or sector. That was the expectation. And it was to be more concentrated, randomly picked. So some of these companies I don't know anything about, randomly picked. And that was it. So far, here's the thing, right? HSV has been acquired last year. So 8% should have been reinvested, which hasn't. It's just sitting there. And I didn't change that at the time. I probably should have. But that company doesn't exist anymore. It's been acquired at a 37% premium. So there was no reinvestment there, and I wasn't really sure what I was supposed to do with that. After that, when you're looking at the exposure, I think a good decision was making sure that there wasn't more than 35% in one individual sector. So if you look at, for argument's sake, semiconductors, they look a little bit more respectable today because we had a pretty decent rally. But this looked really ugly. If you look at Applied Materials, if you look at Micron, if you look at Microchip, what else? Infineon. And then you could also say like Coherent, as we mentioned a moment ago with Lumentum. Lumentum is kind of in there as well. They're like kind of component plays. Sonos more. But there's like 6 different companies that are going to be very sensitive to semiconductors and consumer electronics, etc. And all of those were down heavy. There was no real diversification. So something that I already knew is diversification is pretty important. Here's another thing that I already knew. Like, look at the performance. So against QQQs, it's in line. It's beating the IWM, small caps. It's underperforming MSCI World and S&P. We'll see. It's going to have to average out over a couple of years. But as of right now, it's in line with two of the benchmarks. And it's not a million miles away from MSCI World and S&P. So the takeaway is, when you look at modern money portfolio, Markowitz says there's a limitation to diversification. So there's the efficient frontier, and you have like 25, 35% of your positions. The closer you get to that, you get your maximum return. Anything above like 25, 35 positions, it's over diversification. So diversifying is fantastic for the reasons we mentioned a moment ago, but you can over diversify as well. Markowitz said that. And here we have 20 positions. The Russell 2000 has 2,000 positions. The NASDAQ 100 has 100 positions. And both of those, I don't know what the MSCI World has, but the S&P 500 has 503 companies. So you can see that these are far more diversified. It's the same performance as a company that has limitations on its sector performance. So diversification, there is such a thing as too much diversification. Anything over, like, I don't think I'll be over 25 positions again. And then the question is, like, could I go below 20 positions? Maybe, actually. Like, looking at this, maybe I could. Like, it'll be a little bit more concentrated, but I could probably go below 20 positions. Not too much below, but I'd have to be dead right on what my view would be. So it's kind of confirming a number of things that I kind of already knew, but there's still a bit of time left on it. One is diversification works. Secondly, there is limitations to diversification. Thirdly, valuation matters. So here's the thing, like, I just randomly chose these companies. I still don't know anything about this company, Future, FUTOR, but valuation matters. This was peak valuation. So this peaked out at £39. What price was it paid? Where is it? What price is this? £36. So this was pretty much an all-time high. When we started it, we randomly picked the company, not based on valuations. Look at it right now. It's down almost 71%. So maybe if we considered valuation, we wouldn't have looked at Future. Different situation with Doc Martens. Doc Martens had some operating issues. So the diversification, this is down 65%. Solid, well-run business that hit a wall that might have been an exogenous risk factor. It happens. If you're concentrated, you're down 65%. If you're diversified, you're down 20.89%. If you factor in valuations, maybe you don't get involved with Future PLC, like, just as an example. Let's just have a quick, like, I don't know much about that company. The whole point was I would look at margin expansion. Can't remember, revenue growth. Can't remember. So if we look at the valuation here, well, this is free cash flow. No, we'll look at price to earnings just as an example. Let's look at it over the last 5 years. Yeah, we pretty much bought at peak valuation. Maximum 32, bought it like 28 times. So yeah, valuation matters. Normally I wouldn't buy higher than the average, 19 times. So that would have been out of the question. So yeah, it just kind of reaffirms an awful lot of the decisions that, an awful lot of the stuff that I probably already would like to believe that I already knew. And then the other part of the question is, so yeah, I still follow it, but that's going to be a 3 to 5 year sort of scenario. I'm already beginning to, like, I'm already seeing, like, you know, valuation matters. There is going to be certain things in the stronger performers, like Games Workshop as an example. If you look at Games Workshop, what does this have? So I was looking at some of the stronger performers, and you'll see the vast majority of them have very strong rates of return, which again is something that is not necessarily obvious to a lot of people, because some businesses can go up with, like look at Salesforce, has a 1 to 3%, depending on the year, return on invested capital. It's still performed incredibly well over the past number of decades. But this here is a company that is generating exceptionally large amounts of returns on their invested capital. And so when you look at the companies that are performing a lot better, they have solid returns on invested capital. Like, that's flat over the period when S&P would be down, what, 13%. So the broad index, like, okay, that's a UK company as well, so it's a little bit different. But anyway, you get what I mean. I think at core is the same. I think this one had, well, circumstantial as well. That's why you need ATKR. That's why you kind of need a 3 to 5 year time horizon, because this is an industrial distributor. Yeah, these guys are the same. Very high rates of return over long periods of time. Like since 2016, they've had strong double-digit rates of return. But industrial, I think these are industrial distributor, electronic equipment, but I think they're an distributor, right? Manufacturing sale. The company offers installation, manufacturing infrastructure. Okay, I'm not really that familiar with the company. I thought it might have been a distributor. Maybe they are. Part of the business maybe is distribution. Anyway, looks like there's some infrastructure and industrials which have done very well. Anyway, what did it have? What do they all have in common? The ones that held up really well, high rates of return, high quality businesses. So that's ultimately what I'm looking to find out is which of these businesses, like what's the difference? Okay, if the whole sector is down, like if all semiconductors are down, okay, there's not going to be really much information there because it's really got to do with flows. But if there's like anomalies, it might give us some information for argument's sake, looking at like what are the characteristics of these businesses. The other question is, how does my investing style on eToro compare to my investing style, my personal investing style? It's the exact same. The only difference is I have a couple of positions in uranium that I bought years ago before I was even on eToro. I don't want to sell them, and eToro listed Cameco. I'd buy Cameco, but eToro listed Cameco in 2021. I wouldn't pay those prices. I wouldn't pay the prices until or unless we've seen a scenario where we get above $70 per pound of yellow cake. We're just not there. So these aren't really going to be producing significant cash flows. So I didn't add that. And I also own a couple of positions that eToro wouldn't even list. They're too small. But I have a couple of small positions. Deep Yellow, just betting on the jockey. John Borshoff's the CEO. John Borshoff was the CEO of Paladin. Nailed the last bull market. Took the company from 1 cent a share to $10 a share. Really knows what he's doing. Has his head in his shoulders. Acquiring cheap African assets. Partnering up with the Japanese government for funding to explore. And I'm betting on the jockey, really. Could be a zero, but so far it's up a little bit. The other company I own is Fission. These guys have one mine in the Athabasca region. It's up a little bit. These are small companies. eToro, we're not going to list them, but outside of those companies, that's really it. Yeah. All right. Let me see if there's any more questions. No. Okay, guys. I think we got to the end of the questions. Yeah, I don't really have anything else to add unless anyone has anything to ask and I can help. If not, I guess we'll leave it till the next time. I'm seeing it's a pretty red day today. It's not something I'm too concerned about, to be honest. I think we've bottomed. Like, here's the thing, we have a supposed 2008 global financial crisis. Equities bottomed last October. And here's the thing, like you look at the portfolios, I know it doesn't feel this way, but it's up 22% since the low, which was last October, November. So we're slowly turning over, 5-7 months later, it's 22%. We can keep up that pace. It won't be too long before we're back at new highs, but it's the market. The S&P 500 is already 16% off its lows. Last year, everybody told me I should be trend following, and they were talking about, I don't know, some guy's 30-week moving average rule or whatever. Here's the problem I have with that. I tried trend following. I tried trend following at precisely the wrong moment. I tried it right here. When the market chops like that, it's really difficult to make money. So when you look at this market here, find me a trend follower that's making money. None of them are making money. They're all losing money this year because they're buying on breakouts, they're selling on breakdowns, buying on breakouts, and it's debt by 1,000 cuts. And unless the market trends, you don't make money as a trend follower. So it's all well and good when you sell it in April 2022 and you're like, price is king and this, that, and the other, and price goes down, you look smart. But we'll see in a couple of years. The problem with trend following is you need a trending market, and markets don't always trend. You can go through long periods of time where markets don't trend, and it's debt by 1,000 cuts. I think there are really talented short-term investors that can take advantage of the volatility. I'm just not that person. I can look at something like Lumentum, peel back a couple of layers of the onion, same with MTB, realize that I have a good steward of my capital in Renee Jones over at MTB, and I think Lumentum have a fantastic growth and great opportunity, and whatever the market wants to do in the near term, it is what it is. I'm just not very good at that game. So I personally think we bottomed. I think we're pushing higher. Why? Just like last year, we had a strong economy, but tight liquidity conditions. We've seen equity prices go down. Well, now we've got loose liquidity conditions and equity prices are going up as the economy rolls over. So that's what I think. Yeah. Okay, guys. I think I'll leave it there. We'll do another one anyway in a couple of weeks. So thank you all for your time, and keep you guys posted. All the very best.